It's quite frustrating, really. I was talking with a premium member recently and I shared my bets. I shared, for example, how I bought a lot of long-term government bonds. And then what I hear back is how people go 100% all in on those long-term government bonds. Now, the prices went up because now the market is anticipating that interest rates are going to drop. So that's all fine. But I've got a very big issue with those all-in bets. It's really problematic to go all or nothing in investment. Now, this is somewhat counterintuitive because one might think you have to take on a lot of risk in order to get a lot of reward, right? Risk and reward is interlinked. So the more risk we take, the more reward we should be getting. That's why a lot of people get very heavily into meme coins, right? When you buy a meme coin at the right point in time and then you sell it at the right point in time, you can make 10x, you can make 100x returns. That's something that you cannot achieve with long-term government bonds. So taking on more risk seems to be sensible if you can afford the risk. But the issue is that you can take on a lot of risk without having to bet the entire farm, without having to risk it all. There is a way to optimize the risk to return profile. And that's because different asset classes pay for different kinds of risks. So when you buy, for example, stocks, what kind of risk do you get compensated for? The main risk that you're taking on when you buy, say, technology stocks is that you're hoping that the economy does not suddenly implode, right? When there's a massive recession, then stocks tend to go down. So when you buy stocks, you're getting compensated for taking on the risk that the economy continues to grow. Now, the risks that you take on when you buy, for example, meme coins are not that strongly correlated to the economy, right? When you're buying a meme coin, the main risk that you're taking is that there's simply more attention going forward on that meme coin, right? Meme coin trading is an attention game. So when attention rises, then you tend to make profit with meme coins. When you buy Bitcoin, which I'd consider is a different asset class almost compared to meme coins, right? Even though it's both crypto, I believe Bitcoin is held in a very different way compared to meme coins. If you buy Bitcoin and you hold it over several years, your bet is rather that Bitcoin continues to be a savings vehicle, right? It continues to be an alternative to buying stocks. So you're simply betting on the continued adoption of Bitcoin when you buy Bitcoin. When you're buying a house, you take on even different risk, right? When you're buying a house, you're hoping that maybe there won't be a highway that gets built directly next to your house. You're hoping that there won't be a lot of competing developments directly next to your house that could then increase supply and potentially skew the demand and supply dynamics not in your favor. So the kinds of risks that you're taking when you buy a house is potentially different to the kinds of risks you're taking when buying Bitcoin. Let's say you're buying long-term government bonds. What's the risk that you're taking over there? You're mainly taking interest rate risk, right? So when interest rates are going to rise, your long-term government bonds will go down in price and vice versa. If you think that interest rates are going to go down, then your long-term government bonds will go up. One could even consider US dollar cash, right? Pure fiat as being risky. The risk that you take on when you hold fiat is simply that the monetary base isn't expanding too quickly, right? When you're holding cash, you're hoping that the currency won't suddenly hyperinflate. So you also have a risk over there. But you've got very different kinds of risks with all of those different asset classes. But when you measure those different kinds of risks, right? When you would say you're taking on different risk points, right? You would simply say, I put in that much capital in these different asset classes, and each time I'm taking on different risk points. You can actually take on more risk points simply by having different kinds of risks that you're taking. If you go all in on a meme coin, or you go all in on US long-term government bonds, you're taking on a lot of risk, but you're also increasing your risk of getting bankrupt, right? Your risk of ruin increases because all the risk points that you're taking are concentrated on one type of risk. But you can take on more risk points if the types of risks that you're taking are very different from one another, right? There might be zero correlation between the adoption of Bitcoin and the likelihood of a highway getting built next to your house. And so by not being all in on Bitcoin, but by also having property besides this, you can take on more risk overall. Thus, you can achieve more return overall because, again, risk and return are correlated. The more risk points you can take, the higher your long-term return should be. The main problem with crypto YouTube is conflict of interest. Too many YouTubers shill garbage, promote garbage, and fill up their pockets in the background. Not this channel. Instead, there's simply the offer where I share my skills, my perspectives to you, and where I also share direct access to me, where you can ask me any questions. Feel free to check it out. The premium membership link is down below. But the art is in increasing the amount of risk that you can take without necessarily increasing the risk of ruin, without necessarily increasing the risk that your portfolio goes down by 60, 70, 80%, and you can barely recover from this. You want to take on as much risk as possible without necessarily having to drop by 30, 40 or 50% in the worst case scenario. And you do this by taking on different kinds of risks because it's very unlikely that all those different kinds of risks will play out negatively for you at the same point in time. And so yes, intuitively, we do ourselves a favor by going all in on a very high conviction play. But I think there is some kind of a limit. I think it does make sense to never be more than 25% exposed to a single asset class and to have different kinds of asset classes. And even though the expected return on, say, property might be lower compared to, say, a meme coin, you can still adjust these kinds of risks by levering up your property, right? If you buy a house and you are 90% levered on that house, right? You only have 10% equity in this, 90% is debt, then suddenly your equity is also fluctuating almost like a meme coin, right? The property only has to go up by 5% in value and suddenly you make 50% return on investment on your equity. So you can adjust through leverage, through debt, the volatility and the expected return of even boring investments. The art in all of this is not to get crushed in case one investment goes against you. And you simply do this by owning all kinds of different kinds of risks. The art is in not getting crushed when one of those positions goes against you. And again, you do this by owning different kinds of risks that don't correlate with one another. You can't think about this simply just fundamentally, right? You can think about this as just explained. What is the potential case where my investment could go down? Or you could also do this mathematically, right? Where you simply just look at, say, stocks versus crypto. How much do those different assets move in the same direction at the same time? For example, within crypto, altcoins tend to be very highly correlated to one another. So you can't really diversify away from the crypto risk by owning a lot of different cryptocurrencies. You have to own things that are not cryptocurrencies in order to get diversification. Same for the stock market, right? Just owning 20 or 30 different stocks is not really going to give you any diversification benefits. You have to buy things besides stocks to protect yourself. And you can figure this out mathematically, right? The correlation coefficients are very high within the stock market or within the crypto market, or you can think about this fundamentally, right? Very likely stocks are going to crash when the economy is doing poorly, but not necessarily the crypto market, right? The crypto market is more driven by attention, it is more driven by adoption. Some people say that there is no free lunch in investing, right? You always have to take on more risk in order to get higher returns. But by taking on different kinds of risks, I believe there is some kind of a free lunch, right? Your overall portfolio is going to fluctuate less, but your expected return is going to go up simply by owning all of those different things. And now, of course, it can make sense to take on more risk if you're still young and if your portfolio is relatively small relative to your monthly cash flows. You can then, of course, be heavier on Bitcoin and on meme coins relative to just bonds. But even if the portfolio is small, I wouldn't go 100% on a single sector because nobody knows what happens, right? Things can suddenly flip like this, right? Within a month, Bitcoin can crash 30, 40%. And will you then be able to take advantage of those low prices? Will you still have enough firing power through your cash flow or maybe through selling other assets to buy the dip? Or are you simply just freezed at that point and you can't do anything because you can't buy the dip? I believe it makes sense to be as flexible as possible in every scenario. I think it's important to not just rely on predictions to think about where an asset might go. I think it's also important to be able to be reactive to do something just based on what the asset did. So you're not trying to forecast, you're simply just seeing, I'm now, say, underallocated to Bitcoin, relatively speaking, in my portfolio because Bitcoin went down by 40%. And so I'm going to sell some of my long-term government bonds or some of my tech stocks to buy that dip. You don't have to predict anything there. You simply just see that you're underallocated. And keeping that kind of flexibility is super important. And going all in on anything is completely ripping you from that flexibility. If you enjoyed this video, feel free to share this with your friends. Feel free to also give it a like. It helps the channel grow. And of course, if it's your first time here, feel free to subscribe as well. I publish videos regularly here. Cheers.